Welcome everybody to our quarterly themes webinar here at Zenith Wealth Partners. We like to get on the horn with our clients and teammates each quarter to talk about things that we're seeing in the market, trends, how our portfolios have performed. So we've got an all-star lineup today with Chelsea and Marcus joining us. We've got some other Zenith teammates on the line as well, Lucas, Parthiv, Jonathan, and Sarah, and it's a pleasure to see some clients on here, and we really appreciate y'all joining. We've got a packed agenda today to go through. I'm excited to share some of the themes and just some of our thoughts from the last 3 months and just like what we expect looking ahead. I'll let Marcus and Chelsea go ahead and introduce themselves, and then we'll kick it off.
Good morning, everyone. My name is Chelsea Ransom-Cooper. I've met quite a few of you already, but it's a pleasure to be on to talk about what we're seeing in the market today and how this will also impact your personal finances.
Good morning, everyone. My name is Marcus Coleman. I'm happy to be here this morning, just sharing the same sentiment as Jason and Chelsea. Looking forward to sharing some of our thoughts on the market and also future expectations.
All right, excellent. Well, let's go ahead and dive in. We want to just set the stage with a quick market overview of what went down, what happened in the prior quarter. We'll talk a little bit about performance and like what that means for you, and then wrap it up with just our expectations for the future and looking ahead. And we'll entertain any questions or thoughts that anybody has. Please feel free to stop us, come off mute, or wait till the end. We'll have a dedicated Q&A session, but we'd love for this to be interactive. We'll definitely bounce it around between Marcus, Chelsea, and I, but would love for anybody else to chime in if you have thoughts or questions or anything else. Just looking over the past month of June, at the last month of the second quarter, we've seen a lot of strength in stock markets and equity markets. We see there over on the left, we've got the S&P 500, which is the largest 500 stocks in the U.S. index, up over 6.5%. International stocks, up 4.5%, and then emerging market equities up 3.8%. This is a great month return. Most of our client portfolios benefited from these trends. We've continued to see volatility and downside risk in bond markets, and you can see the Barclays aggregate index down 0.3%. I think this is an interesting trend just in an environment where interest rates are rising. We've got a more hawkish Federal Reserve that is looking to continue to cool inflation data and slow down the U.S. economy with their monetary policy. That has really impacted, credit and bond markets, and has really contributed to our continued theme as we manage client accounts here at Zenith to focus on, equities, particularly dividend-paying equities, to replace some of the income from, allocating away from bond markets as they've experienced this volatility. I think looking ahead, we really in this past quarter saw market participants expecting, the Federal Reserve to go from being, hawkish and restrictive to accommodative and dovish by lowering interest rates or recognizing that the U.S. economy was slowing and becoming more accommodative. And we really haven't seen that. Looking ahead, I would expect more of the same, right? The market is priced in, rate cuts and a more accommodative monetary policy, which may provide more of a backdrop for equities and just assets in general. It seems like we could get more of the same from the Federal Reserve, and looking at the month of June really and the returns that we 2 years ago could still be a good thing for equities and long-term investments. I want to kick it over to Marcus or Chelsea. Any thoughts on those comments or additions there?
Well, it plays in well into the next slide here. talking about performance that we've seen year to date. So going into this year, the backdrop was we're in a hawkish monetary policy. We had global economy slowdown. There was a lot of uncertainty on whether we're going to enter a recession in Q2, Q3 of this year due to the yield curve inverting last year. However, the S&P 500, which for most investors is an index that shows the overall market, it has performed extremely well this year, up over 16%, like Jason mentioned. However, that return of the S&P 500 could be deceiving. The reason why I say that is majority of the returns from the S&P 500 this year have came from 7 mega cap technology stocks due to analysts believing that artificial intelligence, that growth is really going to impact those companies positively. With that being said, that's as an investor, a lot of investors have the S&P 500 index in their portfolio and they feel like they're pretty diversified. But actually, you just need to be a little bit more conscious of, are you truly that diversified? Because if you took out those top 7 performing companies, the S&P 500 will be up only over 2% year to date. Jason or Chelsea, do you want to add into that?
For sure, Marcus. I think this is a good chart. I think it's a great point. We focus on creating diversified investment allocations for clients here at Zenith. So not just investing in the S&P 500 and U.S. equities, but maintaining exposure to international equities and smaller capitalization and smaller companies, and other asset classes like bonds and credit and fixed income. So while the S&P has driven a lot of the large cap asset allocated part of our client portfolios up, continuing to maintain that diversification, rebalancing, and making sure we're not getting too overexposed to large cap US equities is critical, because a lot of risk on the upside for sure lies in those 7 companies, but also if we see a reversal or a downside trend in those large companies that dominate the index, we could see some impairment and some just like outsized losses. So we want to make sure we're always protected against that, and it's a consideration that we're taking here into the next quarter.
Well, looking ahead, we look at a lot of economic data here at Zenith to help us build out customized portfolios for our clients. One of the main backdrops that a lot of clients are asking us is, when is a recession happening? How bad is the recession going to be? Right now, what we see is technically we're not in a recession. Also, how you determine a period was in a recession is a lagging indicator, so it happens after it occurs. But based off of GDP numbers, we are not in a recession. However, as we're all aware, we have inflation in our economy right now, and the Fed has a hawkish monetary policy where they're raising short-term interest rates, so we can bring down inflation. With that being said, every time that the Fed raises short-term interest rates, it increases the probability for a recession. However, as we speak right now, GDP growth is still positive, and the forecast is for positive growth this year.
For sure. Oh, sorry. Go ahead, Chelsea.
I'll go for it, Jason.
I was just going to say, I think this is an interesting, actual in GDP data when folks are asking questions about, are we in a recession? What's the economic environment? To see, GDP being, persistent like this is an interesting trend that I don't think we expected 3 to 6 months ago.
Something I was going to add in regard to how we're perceiving GDP and the overall of the economy. I think it's important to remember that In regard to consumers' balance sheets, so we're thinking about the assets that they have and the debts, they're still pretty healthy, and individuals are still spending. Now they're taking it back quite a bit, so they're spending a little bit more slowly, but people are still spending. We're seeing it especially in travel and food. And even though the labor market, where we've seen quite a few layoffs, we are still seeing consistent job growth as well. So we're seeing some opportunities for risk, which Marcus talked about with inflation and dwindling savings as well, where people are pulling from a lot of the savings that during the pandemic. But overall, we're still seeing things in a pretty healthy place, which is what is relevant in the chart that Marcus just walked through as well.
So that leads us perfectly into our Fed and inflation expectations. So earlier this week, the consumer price index results came out, showing positive signs that the pace of inflation is slowing. Also for the core index is also showing that the pace of inflation is slowing. Big difference between the two indexes is the consumer price index. It includes gas and grocery, which is a little bit more volatile. The core index, that is what truly influences the Fed in the market because it excludes the more volatile gas and groceries. However, even with the positive results earlier this week where we're seeing inflation slowing, we still anticipate that the Fed is going to raise short-term interest rates in July FOMC meeting later this month. The reason why is the target average inflation rate that the Fed is looking for is around 2%. We're a ways away from that. As a result, we still anticipate that the Fed needs to raise interest rates to bring down inflation so it doesn't get embedded in our markets.
Yeah, that's
Jason.
a great point, Mark. Yeah, I was just going to add, we've been saying this, right, in the last couple quarterly webinars that we feel that the Fed's long-term inflation target at 2% is too low based on what interest rates are today, with anti-globalization trends that are occurring and inspiring onshore manufacturing. We feel that a higher long-run inflation may be just a reality of our current economic climate and globalization trends. So, the Fed's in a tough spot. We can't forget their dual mandate here of moderating inflation, but also making sure unemployment is not running too high and running hot. I think as we see inflation data cool and expect the Fed to consider that 2% long-term target, hopefully we start to see more alignment in that long-term target and what we think the long-term rate of inflation will be. Yeah, it'll be interesting to see what they signal in the next meeting. We're all over it, and I think this chart on the right particularly does a good job showing inflation expectations by economists in the market, right? Kind of the median forecast there in orange, trending down over time, showing that people in the market expect, inflation to get down close to the Fed's current target, which I think is optimistic at best.
Something important to keep in mind as well is that as the Fed is making these adjustments to continue to slow down inflation and the overall economy, each rate decision will have a delay. So it will take a bit of time until we actually see the impact of the decisions that they're making, sometimes even up to a full year, and how this will impact hiring and overall inflation. But it's really important to make sure you have a plan in place to prepare your finances for that downturn or that tough economic time before it happens. So what that means is making sure that you have a plan in place in regard to the emergency savings and you have that nest egg readily available too, especially if you're planning to retire, I'd say in the next 2 to 3 years, or if you just don't have that emergency savings and nest egg readily available, having that cash on the sidelines can be really helpful to help you weather the storm as the Fed is navigating this.
So this leads us into, like we've been mentioning this a lot, is the word recession. And one of the leading indicators that most people in the media and also most Americans know is the inverted yield curve. I mean, what does that truly mean? I mean, the inverted yield curve, all that means is the perceived risk in the short term is higher than in the long term. So right now in the market and investors feel like there's still some significant headwinds right now. So I want to be compensated more right now than I would if I took out a longer debt. Now, when the yield curve inverts, it doesn't mean 2 months later, we're going into recession. Typically is usually extremely delayed, around 12 to 15 months from when the yield curve initially inverts, that you will see a recession. Like earlier in this webinar, we showed that the GDP numbers are still positive. S&P 500 is still having strong returns. We're not in a recession now. However, Chelsea just mentioned, monetary policy, the effects are delayed. So every time the Fed increases short-term interest rates, we are increasing that probability that we will have a recession later this year or going into 2024 because of when the short-term interest rates go up, you create a restrictive lending environment in which if you don't have capital, that can spur growth. And as a result, the economy doesn't grow as large or starts to retract. Jason or Chelsea, you have anything to add to the inverted yield curve?
Sure. Yeah, I think, most market participants are looking at the 10-year versus the 2-year treasury yield spread to evaluate whether or not the curve is inverted or negative. Basically, the 2-year treasury yielding more than the 10-year treasury is what throws us into negative territory. So to Marcus's point, as short-term interest rates rise, this becomes more inverted and more telling that a recession is on the horizon in the short term, right, versus the long term. But recently, I think the 30-day treasury yield has gone over and above the 10-year yield as well. So the different durations on the yield curve are now starting to invert more, which is also a telling sign that we could be getting closer to, I guess what people would consider a recession. Looking at the GDP numbers, it doesn't seem like we're quite at this point. So this is an interesting market dynamic that I think speaks to how aggressive the Fed really has been in a short order of time to combat inflation by raising short-term interest rates. This dynamic has always predicted recessions in the past, but we haven't seen a Fed this aggressive in rising interest rates in a long time. So this could be a dynamic and an output of that activity.
I think key points that Jason just mentioned are there are aspects that we cannot control in regard to the economy and how the market will perform. But what we can do is we can take steps to prepare ourselves, our financial life, our wallet for those downturns so that we can at least minimize the stress that we have as we're worrying about potential recessions or market volatility. I think this is also a really key point to make sure that you have a good inventory of where your finances are and what could potentially put you in a negative scenario. So having high toxic debt, not having that emergency savings, or just not having a plan in place on how you're planning to repay your debts, having that inventory now is really, really helpful to make sure that you have a plan in place, even though this is going to be potentially a delayed output.
Love this chart.
Yes. So this is just another example of the economic data that we are watching that tells us if we're close to a recession. So the inverted yield curve is one, but looking at the employment survey, industrial production, retail sales, real personal income, this all gives us, and it gives our investment team insight, and it helps us curate our custom portfolios for clients. So we're thinking far in advance. We are trying to position our clients to really maximize risk-adjusted returns in all markets. So we don't want to scare you. I mean, there are significant headwinds in the market. There are red flags that are popping up right now that are saying, okay, recession is looming. However, like we mentioned, as of right now, technically we're not in a recession. So we position our clients' portfolios as such. However, we are following these key indicators and we are ready to make strategic or tactical moves for that market if it does occur at the end of this year or beginning of 2024.
For sure. That's a good segue into the next slide too, Marcus, just around how we position our client portfolios and how we're thinking about asset allocation looking ahead. Our portfolio asset allocations and target asset class designations that we have in portfolios are driven by two key elements in the market that we're viewing: economic data and the trend element or momentum. Based on those two factors, we set how much percentage clients should have to large cap stocks versus small cap versus international versus credit and fixed income. Most of our clients also have equity allocation targets, so 90% equities or 80% or 70%. So we balance that to create portfolios for clients using those two elements really at the core and the heart of it. As we look to select investments that populate those asset classes, like let's go with large cap core again, for example, we are really reviewing the appeal and the experience statistics relating to the funds that make up that asset class. So a lot of our clients have exposure to the NACP ETF, or it's a large cap core investment selection that we have. We're reviewing, okay, does this product outperform the benchmark, right? Its benchmark is the S&P 500, right? How does it cost compared to the benchmark ETF, right? And on the experience side, like what is some of the risk? What's some of the tracking error? How far behind does it lag to down markets? So really focusing on these particular statistics and evaluating these has been, a recent upgrade, I would say, for our team. We've started to really dial in on our asset class and fund selections that really reflect our thoughts on the economy and the market, but also, really meet the experience statistics as well around risk and tracking error to make sure the asset classes that we set in place for clients meet and act like their investment policies indicate and expect over the long term. So shout out to the whole team, everybody on this call for chiming into this process, and also to our clients for giving us feedback and allowing us to continuously improve and really focus on excellence in how we create model portfolios. Happy to dive in deeper on that. That was a flyover, but I also think we're to the point of the conversation where we are asking for questions. So if anybody has any thoughts, questions, and wants to fire away, please do. Just as a note too, we haven't had Chelsea or anybody from our financial planning team on this webinar in the past. So I think it was good to have her here to make it relatable, and like, we're not just managing portfolios in isolation based on what we think in the economy, but here's what it means for our clients. So Chelsea, appreciate you joining this one. Thanks.
Hey, Jason, I have a question. It's Alan.
Hey, Alan.
So just going back to the, I guess, potential recession, or the Fed preventing that, obviously, and it looks like it's going in the right direction. Is basically what they're doing is increasing interest rates to avoid that. Is that correct? And then if so, do you see that continuing to happen to avoid that, like a continuing rise in interest rates, or interest rates remaining where they are?
Great question, Alan. I welcome anybody's perspective on this. I think if I had a crystal ball on interest rates, we wouldn't be in this business. We'd just be investing our own money and getting rich. No, I'm just kidding. We would at least do it for everybody. At least do it. It's hard to tell. I think when you look, the Fed is in a tight spot, right? The economy seems to be doing okay and chugging along. Unemployment is not running rampant right now, at least from the data points that they look at. So to see elevated inflation and for them to want to act against that is just it's a tough choice because they don't want to slow the economy too much to throw us into a recession. I think what we may potentially see is just like the Fed being slower to raise and like very reluctant to lower rates. So trying to keep them where they are in the marketplace. I think we're seeing mortgage rates at like 7%. You know, that's gotta cool like home buying and like the home real estate. I know it hasn't quite yet, but I think it's potentially coming down the pike, which will be a big impact on consumer spending and you know how the Fed is viewing unemployment and just the overall economy. So, you know, I think we're going to get a, you know, at least through year end, probably a scenario where we see 1 or 2 more hikes, but, you know, for the most part, staying stagnant and staying around this current level, which is good, you know, for people saving money, high yield savings. It's great, you know, for entering into credit and fixed income allocations. To Adrian's question in the chat, you know, having a 60-40 portfolio, 70-30, that 40 and 30 percentage in bonds and fixed income is definitely paying more today than it was 2 years ago, right? We're seeing great, you know, great, what appears to be forward-looking risk-adjusted returns on bonds and fixed income. So I don't mind if the Fed determines that they want to keep rates elevated, and I think that'd be a good outcome for a lot of our clients in our portfolios.
Got it. Thank you.
Thanks for the question. And Adrian, thanks for your question. We can touch a little more on our fixed income. We, you know, we use a diversified fixed income bucket. We have like target dividend, you know, target dividends for our portfolio around 3.5%. I think our fixed income sleeve here at Zenith is yielding 3.6% today, so a little bit above our target based on where interest rates are in the market today. Included in that fixed income sleeve is, you know, the aggregate bond index. We've really focused on lengthening duration over the last 2 to 3 quarters. So we've got a higher allocation to, you know, 10 bonds that are maturing in 10 plus years, trying to take advantage of some of the price volatility that those bonds have seen on the downside as interest rates have risen. The longer the duration of the bond, the more sensitive their price is to interest rate rises. So as rates have gone up, those bonds have really kind of gotten crushed. So we've started to level and layer into those bonds more deliberately to try to buy in at cheaper prices, lock in a higher yield, and position ourselves for hopefully some appreciation of that bond price as we see a more stable monetary policy moving into accommodative, you know, maybe 3, 4, 5 year line.
Thanks for that additional color, Jason. And just one more follow-on question. Is part of your lengthening of duration in bonds a little bit of like a tactical call for a risk-off environment where you're expecting those bonds to do even better than shorter term bonds if there's stock market fallout, for example?
Great question, Adrian. I wish it was that tactical and we had that much of a perspective. I'd say this is more just us getting back to our longer term asset allocation portfolios. We had really shortened our duration when we were expecting interest rates to go up. So we're just kind of pulling it back to what it's been long term. The shortening of duration was really, I mean, I think a lot of folks were doing that, you know, shortening duration, getting into floating rate bonds, things that weren't quite as interest rate sensitive. Now I think we feel a little more comfortable in where rates are and with, you know, credit that is a little bit longer in duration.
Very good. Thank you.
Thank you. All right. Well,
I just want to say, being conscious of time, we do appreciate everyone that joined the webinar today. Even if you weren't able to join the webinar, if you did register, you will receive the recording. If you do have additional questions, even after, say it's this Sunday, you're reading or after you work out, just reach out, send us an email. We'll follow up with you. And Chelsea, just like Jason said, thank you for being a representation from our financial planning team. We don't just create investment portfolios in silos. We have to leverage our financial planning team to make sure that the plan is ultimately going to be successful in the long term.
Thanks. Nice job, Marcus. All right, everybody. It was great to see you. Thanks for the questions, and we'll see you next quarter.